welcome to another episode of Lisbon Investment Society's podcast, Crunch the Numbers. My name is David Tite and I'll be your host for today as we dive into the world of finance. In this episode, we'll discuss value versus growth investments, the Tesla example, and how we should use technical and fundamental analysis. With us today is technical analyst, head of trading platforms and brokerage at Bank Big, our partner Steven Santos. Welcome, Steven. It's really a pleasure to meet you for the first time and to have you here with us. So first to begin, I would like to ask you, what is it really? So I know you work with technical analysis. Can you explain us a bit more what is it about?
Yes, absolutely. So technical analysis is one type of financial analysis where we're mostly working with price charts. So instead of looking at companies and the value of their assets or their revenues or their profits, instead of all that, more accounting and financial information, we're looking at what the actual security is doing. So the actual stock or the actual bond or index or currency pair. So we're actually looking at the price action, the price evolution, and based on several patterns that have been tested in the past, we try to project what will happen next. So we try to have a more volume based insight. We're trying to have a more price based information and not just looking at historical accounting input.
Right. So although value investing has been beating growth investing in the last 90 or years, growth investing has beaten value investing since 2007. So do you think value investing is getting past, or that growth investing has been excessive?
Well, that's a good question. So since the last crisis, so 2008, 2009, there was a big change in the way that value investing started to lose pace, started to lose interest for investors, who by that time, 2008-9, during and after the global financial crisis, looked for growth. So they looked at companies that were growing in terms of their business, their sales, their profits, and try to go after those companies that are really innovating, promising new products, new markets, new growth, and investors tended to flock towards those, big innovating companies. So all the value, the typical traditional value stocks tended to go out of fashion. So we all know what we're speaking about. So the value investing it's a very old school. Started by Benjamin Graham, who influenced greatly Warren Buffett and several other fundamental investors and fundamental portfolio managers. And it intends to pick cheap companies in terms of accounting, cheap financially valued companies with low price to earnings ratio, low price to book. So you're buying out of flavor stocks. So stocks that are beaten down, stocks that are unfairly valued by the market. You think it's unfair for the company to be that cheap, so you just buy the stock. Obviously, you'll have volatility, so obviously you'll have a drawdown when you're buying a beaten down stock, and you just wait. So you just wait for the market gives you reason or gives that company reason. It brings up the value of the company, and obviously it brings up the value of your portfolio as well. So this is a very, very old type of investing. There are lots of academic studies around this showing that it actually was a very good strategy in the long term. However, when you are value investing, you have to be very careful not to pick very beaten down industries and very beaten down sectors. Well, nowadays obviously this would be tourism, cruises, lots of hotels, which obviously are out of business mostly because of the pandemic and the lockdowns and all that stuff. The restrictions obviously stop us traveling and doing touristic activities. So if you're buying those companies because they are financially cheap, you may be buying a problem for yourself. You may be buying a stock of a company that won't be able to survive this crisis and possibly disappear or go bankrupt. Obviously, there are various possibilities for this, but what I'm saying is, if you do tend to prefer value investing, very careful with this, with the sector, with the industry. Make sure that business sector is healthy. There will be consistent demand in the future during the crisis as well, obviously, but try to avoid those very struggling industries. An obvious industry nowadays besides tourism is the oil and gas sector. Many people think this crisis will be it will be the reason or the trigger for people to move definitely to renewable energies. You may disagree. That's my case personally. So you believe that oil and gas companies will possibly survive, and oil consumption will possibly continue more 20 or 30 years looking forward, but be very careful with that. Nowadays, and since 2008, 2009, investors prefer growth. Companies investing, Netflix, Apple, Google, Amazon, companies that are disrupting businesses, companies creating new sectors. Obviously, investors prefer that because they look around in 2008-9, everything was in crisis. Emerging markets were very bad. All the situation was very grim, but there was no economic growth. But there are a couple of companies that are aggressively growing quarter upon quarter. Sometimes the profits aren't growing, so the net profit isn't there yet, but they have strong revenue growth, and they have strong user growth, so they are able to spread their product to many people.
Right. So as an analyst at Big, you also deal with several clients, right, who want to buy shares of several companies. So what has been their behavior? Has there been a change in their pattern post-COVID?
Yeah, I would say so. So basically, people had more time, had more availability for their personal investments, more time to manage their portfolio. So obviously, people did change a lot, especially during the lockdown, March, April, May. So people were very aware of the news, very aware of opportunities. Obviously, lots of stocks went down. Went down a lot during those weeks, and people tried to take the opportunity and buy cheap stocks and keep them for the long term. I believe that was a major shift this year, and it contributed to a great year in terms of business for brokerages and banks such as Big. Lots of people entering the market for the first time. We had people who had invested in the early 2000s coming back to the stock market, so people reactivating their accounts at Big because they wanted to enter the market as quickly as possible to explore some opportunities. Looking forward, I do believe that the retail investors globally now have a bigger weight than they had previously. Obviously, all the discount brokers in the United States had an important contribution for this change, and this behavior change. I believe it will continue somewhere because I believe these people entered at a good moment. Okay, and after a big correction in the markets, they were able to buy stock very quickly. Obviously, markets, especially technology stocks, went up very quickly. So I believe people are happy with those returns, and possibly or probably they will stay in the next years, even if COVID goes away at some point. But I believe people will continue investing in stocks.
Okay, so when you look at the behavior of our clients again, what do you think they're doing to minimize risk and volatility in their portfolios?
Well, what we do try to tell them is to diversify. So diversification is it's a free lunch in the way that you are just giving away a little part of your return. So you're just giving up a small amount of potential upside in terms of your stocks, but in return you are lowering much more your risk. So it's one of the few lunches you can find in finance and economics. So instead of going all in to a single stock, let's say buy your full amount of money in Netflix stock. Okay, if it goes well, you'll be very, very well because it's a tech stock, it's a growth stock, it's very volatile. Obviously, your money will do very well. But if Netflix has a problem, an issue, a management issue, some scandal, your portfolio will do very, very bad. So instead of doing 100% Netflix, what we try to advise our clients and support them in is split your money into 10 different parts, 8 different parts, buy different sectors, different geographies, different asset classes, try to have some gold exposure, some bond exposure. Don't be 100% risk assets. Obviously, we try to help them navigate these markets and navigate this crisis. And I would say that is our major advice to all those people. So diversify, don't go all in, try to survive in the markets, because if you can survive in the long term, it's the best investment you can do in your life. Okay, this is studied. Equities in the long term are the best asset class, ahead of everything, ahead of term deposits, bonds, real estate. It's a very, very safe way to improve your wealth and improve your well-being and improve your life, and have more money at the end of the day, and have more money when you retire one day, and have more money when you need to buy a house or buy a car or whatever. So the sooner you start to invest, and if you can take anything from this podcast and from my speech, take this for the rest of your life. The sooner you start to invest in stocks, the better. Okay, if you can start today, if you're only 20, 21, it doesn't matter. Open an account at a bank that gives you the possibility to invest abroad and put that money working for you. Obviously, you won't get rich overnight. That doesn't exist. But in 10 years' time, you'll be 30 and very, very with a very high level of probability, I would say your money will be much greater than sitting elsewhere.
Yeah, I just wanted to say, so we see a lot of young investors to start with, I'm going to get rich overnight, as you said, and they typically start with short-term investing. They lose a lot of money. Some of them quit right away. So I just wanted to say, for those of you who want to start investing, do your research first. Listen to our podcast. We talk about several ways of investing. Check out ratios, do your fundamental/technical analysis, and you'll do better than most just by doing some research. And I also wanted to bring up the Tesla example. So I just checked today, trailing 12 months, the PE ratio for Tesla is at the moment 832 compared to an industry average of 8.96. So we see Tesla having a PE ratio that is not sustainable on the long term. Everyone is really surprised how it even got there at this value. So my question is, what is your take on the rationality of Tesla investors?
Well, David, I believe this is related to growth investing. So instead of value investing, people are crazy about these disruptive, innovative companies. Obviously, those numbers don't make sense in terms of, financial valuation. So you said price to earnings ratio over 800. So would be assuming 800 years just to pay back with the current profit. So obviously this is crazy. This is absolutely out of this world. What is happening there is that people are betting on a huge increase in profits. They're betting on Tesla taking on a big slice of the industry, the car industry, which is obviously very, very beaten down. It's struggling, especially in Europe. The automakers are going through a very bad stage with lots of debt, and obviously this crisis is horrible for cars. So I would say that the way to justify and understand that is that people are just looking for a crazy amount of growth in Tesla. If they are going to achieve it and justify their valuation, obviously that's $1 million question. I do agree with you. I believe this valuation is hot. I do believe it's very stretched, and we should come down naturally. But the fact is, you can't find growth elsewhere. You can't do it with Volkswagen. You can't do it with BMW. You can't do it with Ford Motors. So you do need to put money working for you, and investors believe that's the best way to do it. Obviously, Elon Musk, he's very good for media. He's very good for investors because he's a dreamer. But besides being a dreamer, he's a doer. So he makes things happen. He's very ambitious, and he's done lots of crazy stuff. And I believe he'll be continue doing lots of crazy innovations in the years to come. And obviously, people look at him and see a new Steve Jobs. They see a new dreamer, a new leader able to change the world. I do believe Elon Musk goes beyond that. He doesn't want to change the world. He wants to change humanity. Obviously, he has his very aggressive goals for SpaceX and all these, the space exploration company has. Obviously, I do believe he wants to go beyond Steve Jobs, but that attracts people, that attracts investors, that attracts newspapers. But at the same time, it's a huge risk because you have a key man risk. If something happens to Elon Musk, I can't imagine what would happen to the Tesla stock. I don't know if someone's tried to estimate the impact, but it would be huge because the company is Elon Musk.
Right. Personally, for me, Elon Musk is an icon, not only because of his job and how he started, not even about the way that his hair grew back, but if you look at his Twitter, for instance, it's not that he's a down-to-earth guy, but you can see that he does common things like us. So if you just go to his page, he watches TV shows that we watch. He made a flamethrower, I think, not so long ago. So it's like he made this industry like the big CEO thing everyone is afraid they won't get to, more accessible. Like, if a guy that likes the same things I do can get there, why shouldn't we? Why shouldn't I? Or why couldn't I? So for me, it's truly an inspiration. I mean, I can agree or disagree with what the industry does, or if launching a car to space is a great thing or not. But just that drive he has, I mean,
yeah, absolutely,
motivates me to do better and more. But anyway, going a little bit back, I want to ask you, since most companies are under significant financial pressure, are technical indicators better than fundamental indicators for short-term investments?
Well, considering that many companies are in financial stress, well, the best way to value them and take an investment decision is fundamental analysis. I don't have any questions regarding that. So you do need to have a good understanding of the industry, and within that industry, the positioning and the competitive advantage of that particular company. And after you do that evaluation, and after you do that, number crunching, then you should look at the stock and look at the actual chart. But obviously, it has to be driven by numbers and by the company fundamentals. I don't have any crazy ideas about just look at the chart and the chart will tell you what to do. Obviously, if you are short-term trading, If you're just buying and selling within days or within 1 week, obviously you can do that and be successful. It's hard, but you can be successful just with price action and technical indicators, Fibonacci, and all that stuff. But to be successful in medium and long-term investing, you need to know the numbers, you need to know the company. Okay, that's full stop for me. There's no question. Regarding your question, so yeah, just start with the numbers, start with understanding the company, as well, and be patient, because obviously you're buying stock at a very hard time. A huge economic and social crisis is starting to present itself in several indicators. Unemployment, obviously, we're in a crisis, but at the same time, we need to be careful with our job, but with our health, with the health of our family. Obviously, this is challenging for everyone, but if you are on top of all that, investing in stock or buying stock for the first time, you need to have patience, okay? Because obviously you have to be willing to take huge swings in the value of your portfolio.
Right. So from what I understand about your statement right now, you think we should use fundamental analysis and technical analysis together in most investments, at least?
Yeah, well, that's the way I do. So when I invest for the medium long term, that's the way I do. So I try to scan and filter down companies so I can have just a handful of potential investments, a handful of stocks, try to look at them, understand them, see if they are very leveraged in terms of debt. I try to understand if they are paying a dividend. If they're paying dividend, where does the money come from? Are they giving back all the money to investors, or are they keeping money to secure, give more reserves to the treasury of the company? I try to understand if that dividend is sustainable with the current crisis. I try to understand what markets are they operating in, if it's just a US stock or if it's a worldwide company. You need to obviously filter down this to 5 or 6 different stocks. And then obviously I look at the charts. I try to understand and then identify support zones, support levels. Where can the price rebound? When was the last time that the stock went to this price? Was it 2 years ago, 5 years ago, 10 years ago? I try to understand if that's a new low for the company. Lots of oil and gas companies in Europe are doing that right now. Repsol here in Spain, Galp here in Portugal. It's not in all-time lows, but it's at a multi-year low. So I try to see all the surrounding context for that stock and for that price chart. And after all this analysis, if you tick all the boxes, okay, value of the company, dividend, leverage, obviously you can look at what professional equity analysts are doing. You can, look at the consensus, what's the market consensus for that particular company. And if you're comfortable, the chart is okay for you, you see, a good support zone, you see an upward trend line, for instance, you just need to buy. Okay, buy and wait, and always try to invest as, if the market had to close for 20 years. Okay? As Warren Buffett said, don't buy something that you would, change your mind in 2 minutes or 2 weeks or 2 months. You just buy and forget about it, because you're doing long-term investment and you want the company to pay you back in the next months, in the next quarters, in the next years. And obviously compensate you for the volatility you're willing to take now.
Right. So do you think at the moment that the market has corrected itself? Is it fairly priced?
Well, fairly priced. Well, that's always a difficult question, because obviously, the market in February, but especially March, had a very, very big correction, about 20% for some market indices. So some companies went down 30%, 25%. So this was a major downfall. Obviously, some companies entered, bear market. So if you go down 20% 20% down regarding the top, regarding the highest price, that's considered a bear market. But quickly the markets started to retrace. So in April, markets slowly started going up again. Okay, but the markets were mostly pulled by 5 or 6 big names, tech stocks, growth stocks that have a huge weight in most indices. Okay, S&P 500, NASDAQ 100, Dow Jones. These companies were very important to bring up all those market indices. Obviously, the stay-at-home stuff, the lockdowns contributed to these digital techie companies. In the last weeks, last 2 months, the market has lost some strength. We've had some lateralization, and now markets are starting to fall again. The US elections will be next week, so next Tuesday. It will be a major event, getting to know if Donald Trump is re-elected or not. In my personal opinion, is that if Trump loses the US elections, it will be very bad for stock markets. Obviously, for everyone, Trump loves to deregulate, all the bureaucracy for the companies, all the restrictions applied to the financial sector. He loves to take away taxes on companies and people. He loves to stimulate the economy. He loves to have very, very low taxes for everyone. So obviously this is good for the economy, and it's good for companies, and it's good for stocks. So obviously this is a very, very positive political framework. Obviously, this was very, very well recognized by investors in the last 2-3 years. Trump wasn't able to execute his infrastructure plan, which was a very big expectation 4 years ago. I do remember the day that he won. It was a crazy day in terms of volatility. Initially, the market tanked when the first news came out that, Hillary Clinton is going to lose, Trump is going to win, so markets went down like crazy. But then the markets started to soak in and understand what Trump would represent for financial markets and for the economy. And so in a couple of hours, the US markets reversed and started going up like crazy. So Trump was he facilitated lots of needs of the companies, needs of business people, and needs of workers. So obviously he was very good for financial markets, and I believe that will be decisive for the rest of 2020. Who's going to win, Trump or Biden?
Right. I think this is a very good note for us to finish. It was a very, very interesting to bring politics to the table. I was not expecting, honestly, but it was a very good insight. So I'd like to thank you again, Steven, for coming. It was a great talk. I think our listeners will agree. And I'll hope to talk to you again soon.
Yes, likewise. Thank you very much for inviting me.
Goodbye.
Thank you. Bye.